Good morning, everyone. Welcome to this update for global markets for the 22nd of November. And the US market, and in fact the Australian market as well, finished the week in very positive fashion. So we only had a fairly brief pullback over the last week or 10 days, and we're certainly back to pretty market-friendly conditions. So let's see how things are shaping up for the run into Christmas. So starting with the American stocks, first of all, the S&P was up by 66 points, which is that's a big rise. 3.3% in the week is quite a substantial rise. So that is very positive. The fact that the market only pulled back to the 38.2% retracement level is also a sign of strength. A deeper pullback would suggest something else. And also the fact that the market, there wasn't follow-through selling in reaction to the Paris attacks. It really only impacted the market for really a few hours. I couldn't even say that it really impacted the market for a full day. So that was pretty impressive as well. And the other thing, as we'll see from looking at the chart, is that all of the rebounds since the big sell-off in late August have been extremely strong, even though the market may have then turned over and gone down again. Every single rebound has had some huge up days and in consecutive fashion as well. So there's certainly a lot of buying support comes into the market from time to time. There is a band of resistance on the S&P index between roughly where it is now at a little bit above where it is now at 2114. And then up to the all-time highs at 2130, but above that, it's blue sky. And I think there's every chance that the market could get into that position before the end of the year. One of the reasons being is that a lot of fund manager money in America is still on the sidelines. And the one thing these guys cannot accommodate at all is underperforming the market because their clients are going to take money out. So I've spoken about this before. If you really want to understand where the market's going, you should always look to the self-interest of the major players, and the self-interest of fund managers in America is going to be they're going to be forced to chase this rally to A, maximize their bonuses, and B, avoid clients pulling money away from them. So I think this is really a market-friendly position, at least for the run into the end of the year. Now the Nasdaq index has done extremely well, and in particular the technology section of the Nasdaq index, and it's still leading the way. It's the strongest sector. Small caps are improving. They're still lagging the other indices, the other parts of the market by a significant amount, but they are improving, and this is seasonally one of the best times of the year for small cap stocks. So let's take a look at the S&P, and we'll start with the monthly chart. So you can see we had that big dip. That first big red candle is the dip in August. Late August it occurred. We then got a little bit of a bounce off the bottom before the end of the month. September was then down as well, and then we got a huge October, which really reflected exactly what we saw in 2011. It's such a carbon copy of 2011 that it's amazing, and we're seeing exactly the same thing play out here. So that's the monthly chart, still looking quite positive, and you can see just how close we are to the all-time highs. Turning to the daily chart, so you can see what I was talking about before. After the late August plunge, look at the rebound, 2 days, 2 massive up days. Then we got another run to the downside. Then again, look at all these very positive days, 1, 2, 3, 4 of them. They're significant positive days. We then, of course, as markets are almost designed to do because of human psychology, we then get a retest of the lows. And then the really powerful rebound occurred. Just look at all these huge big green candles all the way through here. We got a pullback to the 38.2. That's from the top of this range here to the bottom to the previous trough. So you can put a a retracement scale on that. These are the standard levels, 38.2, and you can see the market came back to exactly that level and then bounced. That also happened to be the high from the 17th of September. And again, look at the strength of the rebound. Monday the 16th, Wednesday the 18th. Really, really strong rebound days. So it's just indicating that when the selling is done, which is a lot about computer algorithm trading. So when the selling is done and the computers ease off, the rebound selling that comes in is equally powerful. So that's how the American market sits at the moment. If we look at the Nasdaq, there's the Nasdaq index. It's cleared its July highs. Hasn't quite got back above the November highs yet, but give it a few more days and it'll probably be there. Certainly appears as though it's going to be there before the end of the year. Now, the other chart we've been looking at is just the Russell 2000 index on a weekly basis. So you can see it's quite a bit weaker than the main indices. But as I said earlier, this is seasonally not a bad time for small caps in America. Turning now to Aussie stocks, the Aussie dollar is still in this range, but it did rise on the week, which is a little surprising because we had weak commodity prices during the week, iron ore in particular. Oil was steady, but copper was down. So really, pretty weak conditions. And we also had a higher US dollar as well. And yet, despite those two things that you would think would normally drag very significantly on the Australian currency, our dollar went up, which is really quite strange. And it may well be, due to relativities to perhaps the euro and other currencies. However, the big picture drivers are still to the downside. I expect to see continued US dollar strength, probably at a slower and slower pace than what we've seen over the last year. But I still expect to see the US dollar rise further, and that will continue to keep the lid on the Australian dollar. The ASX 200 surged by 205 points on the week, so that was a very big week. But we saw nothing from the miners. It was all in the banks. That's where pretty much all of the gains were. Let's just take a look at the US dollar index. So if we go right back to get a big perspective, you can see the highs that were formed in the US dollar in 2002 were at the basket weighted index price of 120. You can then see from 2002 until 2008, the US dollar lost about 45% of its value relative to other currencies. And that was a fair bit about strength in the yen and strength in the euro. But it went from 121 down to 71. We then had a bounce. We bounced around for several years. We formed a higher low in April-May 2011. And then since then, it's been all upside, and we're bordering back on 100 now. So the US dollar's gone from the mid-70s back to 100. And you've got to say that chart pattern still looks extremely positive at this stage, and I would expect to see a continuation of this rally above 100. But as I indicated, that's been an enormously strong surge in the US dollar. I would expect to see that rate of increase slow down quite considerably. So if we look then at the Australian dollar, there's the Aussie dollar really in this range between 69 and around 74, 75. And yeah, a bit of a surprising week, as you can see, a couple of gaps up there. So not quite sure what the reason for that is, but one of the things I've learned over the years is that often you are best served to ignore the day-to-day fluctuations in the market and just look at the trends and observe the fundamentals. Turning now to commodities, gold was lower by $5 for the week. So as I pointed out last week, we've broken long-term support in gold. There was a long-term inclined support line that's been broken, and gold did nothing to rally back to it. And it was an even worse week for gold stocks, as we'll see from the chart. An absolute shocker for gold stocks. So let's look at the gold price. So there's the gold price on a weekly basis. We've been looking at this long-term uptrending line that was formed by lows from 2006, 2008, and then lows in July of this year. We got a very weak bounce, and now we're back down again. Now there's a key level at around just around $1,020. That would certainly want to hold. Otherwise, I think if that breaks, you're probably going to see some concerted selling come in just on a technical basis. So the gold market looking extremely shaky at this stage. And if we look at the gold stock indices, they do absolutely nothing to fill you with any confidence whatsoever. So you can see there's the 2008 lows. So we're well and truly below those. The market wasn't able to rally back up to that breakdown level, which is what you would quite often expect to see. So we'd expect to see a rally back up to that level. Couldn't make it, and now it's falling away again. So gold stocks are at levels that we haven't seen for more than a decade. So certainly not good signs there. Copper dropped again down to $2.09. That's partly US dollar strength, but it's also partly the fact that there's been selling in copper, reflective of concerns over the global economy, which I think are overdone, but also some elevated inventory levels. Crude oil managed to hold steady at 42, but it did dip below 40 very briefly. So from my perspective, the downward pressure continues, and certainly I don't think there's been enough done in the supply and demand balance equation to really change the picture for crude oil at all. There's the spot copper chart. You can see it's really in quite steep decline from 240 in October, and we're now down under 210. So not looking good there for copper. So just to wrap it up from an overall strategy point of view, I continue to see an environment, and I'm speaking over the next 6 months to a year, possibly 2 years. I continue to see an environment which will be supportive of equities. Now, it's not to say that we're going to have a raging bull market, but it's just the kind of environment where it's not that good that it's going to get overheated, and therefore we're going to get a big correction. I think we're just going to get mild economic growth. We're going to get mild corporate growth, and we're probably going to get fairly mild stock value appreciation. And under those conditions, the market never really gets ahead of itself to warrant having a lot of profit taking or a big sell-off. So I just think it's one of those kind of mild, tepid environments where good stocks can shine. It's not that the American economy is great. They're pretty much better than everywhere else around the world. But the economy's not that great, but it's just not bad enough to warrant interest rates being raised quickly, which would be probably the thing that would derail the bull market the most. So I don't think that's going to happen. And it just looks to me like a very good environment for good equities. Yes, there'll be lower quality stocks that'll get smashed, but if you maintain your focus on high quality stocks and you buy them at good value and you buy them after dips, it's a robust formula that works pretty well. Now, the increasingly higher volatility that we've seen, 2013 and the early part of 2014 were really quite low volatility periods. Since then, the volatility started to ramp up quite a bit. And I think that's just indicative of the fact that investors are getting more and more skittish about events that come along. So they're much quicker now to pull the trigger than they were. And I think that's only natural as, we're in year 6 of a bull market, year 7 next year. So I think that's only a normal reaction to expect. But that doesn't mean that the market can't continue higher. In fact, in a sense, it's a good thing because we get opportunities to buy stocks at prices that we normally wouldn't get because people panic. When you look at some of the opportunities that came out of the August little mini crash that we had, there was some fantastic bargains available during that period. If you were prepared and you knew what you wanted to buy and you had some orders in the market, there were many stocks that rebounded by 30-40% in just a week or two. The best earnings growth remains in the healthcare sector. Not talking about price, I'm talking here about the growth in earnings. Healthcare was clearly the outstanding sector in the latest lot of quarterly earnings in America. Now, you wouldn't know it looking at the share prices because the share prices have by and large done nothing. So what we've got is sentiment temporarily outweighing the fundamentals. But that's the sort of situation where, again, if you know what you're doing, you know what your targets are, that you can do extremely well. So that's it for the rundown for this week. We've got Thanksgiving in America this week, so it'll be a shortened week. Probably, we'll have a sideways market, and then hopefully after Thanksgiving we'll get some strength into the end of the year. That's it for this week. For any non-members that would like to talk to me about how I might be able to assist them in the market, there's my contact details. Talk to you next week. Cheers.